Good morning, everybody. It's your friend Nate. This morning I wanted to talk about interest rates. I wanted to expand on the concept of the risk-free rate and the impact it has on all other investments out there. So to start out, when interest rates move, they impact stocks, they impact bonds, they impact real estate, they impact everything. And that's because interest rates are the leverage point which changes today's value of the risk-free rate. And the risk-free rate, the long-term bond rate, right, is the leverage point that moves valuations for all assets relatively up and down together. So, for example, the reason why it's called the risk-free rate is because all things being equal, other than a default scenario, you're going to, at least in numerical terms, be paid the interest rate that you agreed upon with the government, right? Long-term government bond rates and so on. Now, if you were to move away from the security of that promise at the federal government level, you'd want to be paid a premium, right? So that's where now you start to see a premium for, let's say, corporate bonds, because it's not the government's promise after all, right? Now it's a corporate promise, and they'll pay you, a few percentages more maybe for a corporate bond at the same time. And let's say if you want to disengage from lower return, more secure investments, maybe you could invest in real estate, right? And for that, you could get a little bit higher return because you're taking more risk, right? You're no longer a bond holder. You don't have a claim on things if things were to go to default. And even more so, if you're willing to outweigh the volatility and invest for the long term, the stock market has an even further premium paid over the risk-free rate. So what does this look like? Why do we have different rates of return for different investments, and why do certain asset classes move, certain segments move when interest rates move? And it's because as soon as you move that foundation, right, everything else kind of shakes accordingly. If bond rates, long-term bond rates are 2 or 3%, that means maybe corporate bonds will be a little bit more than that. Real estate will be returning somewhere around 4 or 5%. And then stocks should be almost twice that, right? 8-9%. So just keep these things in mind, and it shows you why the markets can be driven by emotion so much, right? Because you have these fluctuations, and then you have people's emotional responses to those fluctuations, which further forces sentiment like a pendulum, right? Too far in one direction and then too far in the other direction, hardly ever in the space of fair value at any given time. Thanks, guys. Like and subscribe.